Okay, so we have got this question here. Zamtel merger with and restructuring. Zamtel, the Zambian telecommunications company, has been undergoing significant restructuring since the government repurchased it in 2021. To enhance its competitive position against market leader MTN and fast-growing Airtel, Zamtel board is considering a strategic acquisition of Swiftcom Zambia, a profitable and fast-growing internet service provider and fiber optic network operator. Swift.com has strong presence in Lusaka and the Copper Belt, offering high-speed fiber to the home and business connectivity, an area where Zamtel has been weak. The merger is intended to create synergies by cross-selling Zamtel's mobile services to Swiftcom's customer base and Swiftcom's fiber service to Zamtel's customers. So, colleagues, as we can see here, Zamtel is competing against MTN and Airtel. Now, Zamtel has been having problems in terms of internet. Okay, so they want to merge with Swiftcom. Okay, because Swiftcom is a good internet service provider and it has got a strong presence in Copperbelt and Lusaka. So when Zamtel merges with Swiftcom, it means there's Zamtel subscribers who have the benefit of enjoying Swiftcom services, and also Swiftcom's customer base is going to also enjoy the benefits of Zamtel. Okay, because Zamtel wants to be competitive in the market. Okay, so this is the financial data for Swiftcom Zambia for the year ended 2023. After tax, 50 million. Okay, that's your profit after you deducted the taxes on the financial statement. Okay. Number of shares outstanding, 100 million. This company has got 100 million shares. Okay. Earnings per share, 50 ngwe. Okay. Colleagues, what is earnings per share? We looked at this last week. What is earnings per share? To see who's following. Madam Melissa, earnings per share, what is it? Who, who will be getting that? Yes, this is the earnings. This is the theoretical earnings that each shareholder can get. Earnings per share is under the assumption that all the profit that Swiftcom makes, all that profit is distributed to the shareholders. That's earnings per share. But in real life, the company can't just pay all its profits as dividends and give it all to the shareholders. They need to keep some of those profits. Okay. So earnings per share is if when the company decides to distribute all of its profits after tax, if it decides to distribute them to the shareholders, that's how much each shareholder is going to get. Colleagues, are we all okay with that? Okay, dividend on current market price per share for Quach. So, if you want to be a shareholder in Swiftcom, you go to Osaka Securities Exchange and you pay a 4 Quach. Okay. Oh, nowadays you can even do it on your phone. Okay, there are apps for Osaka Security Exchange. So on your phone there, you buy a share for 4 Quach. Okay. Dividend per share, colleagues. What is dividend per share? Madam, let's see, Madam Lillian. Dividend per share, because I have to make sure, colleagues, as we are doing our lessons, you're understanding these terms, okay? I need you to understand all of these terms. Let's see who else is on the call. Yes, Madam Judith. What is dividend per share? Wow, colleagues. Sure, sure. Let's see who's on the Madam Hamanjanji, Madam Mary, Mr. Kennedy. Okay. I hope you have a yes, good evening, son. Can you be okay? Yes, 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 yes. Dividend is what the shareholder gets. Okay. This is the actual money that is paid out to the shareholders. Okay. A portion is removed from the profit after tax. Okay. Earnings per share says all that profit after tax is given to shareholders. Okay. Always remember, first you have to remove preference dividends. Okay, colleagues, I need you to know the difference between a preference shareholder and an ordinary shareholder. Okay. Yes. So dividend per share, this is how much dividends each ordinary shareholder is getting. All right. Then we've got this term which is here. Let's see, because I want you to understand all the terms in this question here. Book value of net assets. Uh-huh. Did someone raise their hand? Good evening, madam. And I've been saying that throughout the class. Can anybody help out to see who has heard? Can anybody help out? Remember, when a fellow colleague explains, sometimes they can even explain better than me. Okay. So, can anyone help out? Yes, Madam Judith, you can help out. What? Oh, you're the one who was asking. Okay, okay, okay. Colleagues, okay, Madam Judith. Earnings per share. Okay, it's when that the net profit which a company makes. Okay, if it gives all of that to the ordinary shareholders, that is earnings per share. Okay, on the financial statement, when you see the financial statement and you see there net profit. Okay, if all that money is distributed to the shareholders, that's earnings per share. Okay, then dividend per share. This is the dividends that are paid out to each shareholder. Okay. From that net profit, a certain portion is removed as dividends. Okay. And those dividends is what forms the dividend per share. Okay. So earnings per share, the whole profit is given to ordinary shareholders. Dividend per share is the dividends given to the ordinary shareholder. Is that okay, Madam Judy? No, let's make it um, let's make it sink in. Okay. Let's make it sink in. Yeah, you know what net profit. Okay, so ask maybe. Yeah? Nobody. It's a theoretical, but it's a theoretical value because a company rarely pays out all of its profit, gives it all to the shareholders. It's very rare. Okay, so nobody, Madam Judith. Okay, because a company won't give all of its profit to the shareholders. Wonderful. Now, colleagues, are we okay with those two things? Because you're going to see this in your exam. Okay, you will see this definite. Okay, you're going to definitely see this. Okay, then the other term, this book value of net assets. When you hear book value, this is just according to the balance sheet. Okay, now remember the accounting equation. Accounting equation is assets equals liabilities minus capital. Okay, assets equals liabilities plus capital. Net assets is basically your total assets minus your total liabilities, which is just the same as saying your capital. Okay, net assets is your total assets minus the liabilities. That's what is your net assets, which you can think of as your capital. Because if you make capital as a subject of the formula here, it's your assets minus liabilities. Okay. So your net assets, colleagues, think of it as the capital. Okay. Or in terms of, since we're dealing with companies here, so we don't use the word capital, we use the word equity. Okay. So Swift.com, okay, according to their balance sheet, all the assets that they have, if they subtract the liabilities, this is the value of the net assets or the equity. Okay. According to the balance sheet. When you hear book value, just know we are looking at the balance sheet. Okay. Yes. Any questions? Industry average PE ratio. Colleagues, even last week we looked at PE ratio, price to earnings ratio. So let me say what it means again. Okay. Please write this down or please don't forget this. Okay. You can forget it after you graduate, depending on what industry you're working in. Okay. If your company is not a public limited company and also you don't have shares in any companies and you don't worry about the financial markets, you forget about this course. Okay. But if your company is a public limited company, okay, and you are interested to know about financial markets and how they operate, so that you can be a possible shareholder in a company, so they can be receiving dividends. Okay, you want to retain this information. Is anyone a shareholder in here? Wow. Yes. W- Okay, that's good. Anybody else? Okay. So, madam, that's good. Okay. You should give us more insights about how it feels to be a shareholder. Okay. I'm also getting interested. I want to actually get some shares in a company. Okay. So, it'd be nice to discuss these things. So, price to earnings ratio. Okay. This is how much investors are willing to pay just to earn a one kwacha from the company they're investing in. Okay. Or from the shares of the company they're investing in. That's price to earnings ratio. Okay. How much investors are willing to pay just to earn one kwacha from the shares of a certain company. Okay. This ratio helps you, it helps you tell if like a company is growing big, investors have got confidence in it. Okay. Because the higher the PE ratio, the more confidence investors have in a company. They believe this company is going to succeed, it's going to make profits. Okay. They have confidence in it. So find price to earnings ratio can increase. If it's a low price to earnings ratio, then it means investors are willing to pay less to earn one quarter from the shares. So it might signify that there's less investor confidence. Okay. So here, when you see price to earnings ratio of 10, it means industry average price to earnings ratio. It means on average, okay, in this industry, this telecommunications industry, investors are willing to pay 10 kwacha, this 10. They're willing to pay this 10 kwacha to earn a 1 kwacha in the shares of the companies within that industry. Yes. Additional information. Zamtel management estimates that merging with Swiftcom will result in annual pre-cost savings and revenue synergies of 30 million. Zamtel is considering an offer to acquire 100% of Swiftcom. They want to fully own it. Okay? They want to fully own this company. Okay? Zamtel's shares are currently trading at 6 kwacha per share. Corporate tax is 30%. Okay? So, part A, using the following valuation methods. Estimate the value of Swiftcom, Zambia's entire company, 100%. Number one, using the price to earnings PE ratio method, which uses the industry average. Okay. So with this PE ratio method here, the formula is just this. Um, the company's earnings after tax or its profit after tax which is basically your net profit, multiplied by the industrial PE ratio. Okay, here now we're trying to value Swiftcom, okay, colleagues? We are trying to value Swiftcom. Okay, so the first valuation method is the PE ratio method where you multiply their earnings after tax or net profit. Okay, in this case here, this 50 million. You multiply the earnings after tax or the net profit by the industry average. Okay. So 50 million is the earnings after tax for what company is on Swiftco. Okay. So we're going to say 50 million times 10. The industry average P ratio is 10. So 50 million times 10, 500 million. Okay. So this is the value of Swift Co according to the P ratio. Okay. So using this method, if since Zamte wants to purchase 100% of this company, they should pay 500 million according to this ratio. Any questions? Value it using the net assets basis, the book value method. Okay. Here we've already been given the value. There's no need for calculating here. Book value of net assets 300 million. Okay. Yes. So according to this method, the net assets basis or the book value method, the value of Swift.com is 300 million. Okay. Any questions? Any questions? Okay. Then the third method using the dividend yield basis method. Okay, so here they have already been given a hint. Value per share, it's dividend per share divided by required return. Okay, required return, this is the return the investor wants. Okay, so here required return of 15% means that's what an investor is expecting as a return if they invest in this company. So let's first find the value per share, dividend per share divided by required return. Okay, so the value per share is dividend per share over required return. So our dividend per share was 20 ngwe. Required return is 15%, which is 0.15. So 0.2 divided by 0.15, you get 1.333333. That is the value per share. Now we want to find what is the value of this company. So if we know the value per share is 1.33 and we have how many shares? 100 million shares. Okay. Here in the information they told us here, shares outstanding here, 100 million. Okay. This means how many shares Swift.com has? 100 million shares. Okay. So shares outstanding, so 1.33 times 100 million, you get 133,333,333 kwacha. That is the value of Swift.com using the dividend yield basis. Okay. Three different valuation techniques which have given us three different values. Okay. Yes. Any questions so far? Yes. Madam Melissa, which one would you use if you are in this scenario? Which method would you use to value this company? Which method do you think has convinced you more? The net assets method the PE ratio method, the dividend yield basis method. And speak from it if you are Zamtel who's wishing to acquire. You're part of Zamtel's team. Which one do you think you would have would you use? Yes, because it means you pay less for Swift.com. Okay. Mhm. P- yeah. Oh, here we're not getting the price to earnings ratio, the actual ratio. No, here we are using it to value. So the formula it becomes this, madam. This is the formula for the valuation method, PE ratio valuation method. That one which I've said, that's where you get the actual price to earnings ratio. Okay. But here when you're valuing a company, you use this formula, madam. That's the way I can put it. You get the industry PE ratio and the company's net profit. Okay. Basically, well, when you hear this PE ratio method, you're using just the industrial PE ratio to multiply by a company's net profit. Yes, when you are getting the PE ratio for the company, use that formula which we just said. But when you're using this method to value a company, you get the industry PE ratio, which was calculated using that formula you have. Okay, madam. That formula for the PE ratio has been used to calculate the industrial PE ratio here, and is what you multiply with the company's net profit. Don't know if that makes it sound better. Is that okay, Madam Judith? You can ask where you're still confused. Okay, I can go to part B. Zamtel plans to make a share for share offer to Swiftcom's shareholders, offering one Zamtel share for every two Swiftcom shares. Calculate the offer price per Swiftcom share implied by this exchange ratio. Okay, so the ratio is this. One Zamtel share for two Swiftcom shares. So meaning if you are a shareholder in Swiftcom, before I interpret, colleagues, what does this mean if you're a shareholder in Swiftcom? This ratio. Zamtel has come and said, we're going to give you one Zamtel share for two Swiftcom shares. So what does this mean, colleagues? As a Swiftcom shareholder, you're giving up two of your shares just to get one Zamto share. Okay, so if you had 100 shares in Swiftcom, how many shares are you going to have in Zamto? If you had 100 shares in Swiftcom, how many shares are you going to get in Zamtel with this ratio of what? 50. Yes, you're going to get 50 Zamtel shares. Okay. So we say, remember, one Zamtel share is worth 6 kwacha. Okay. One Zamtel share is worth 6 kwacha. So if two Swiftcom shares, so two Swiftcom shares will be worth 6 kwacha. Okay. Two Swiftcom shares are going to be worth 6 kwacha because they're equivalent to one Zamtel share. So how about one Swiftcom share? How much will it be worth? Okay, this is the what we're being asked to calculate here. Okay. One Zamtel share is equivalent to two Swiftcom shares. And one Zamtel share is worth 6 kwacha, implying that two Swiftcom shares will be worth 6 kwacha. Okay. So what about one Swiftcom share? How much will it be worth? Colleagues, how much one Swiftcom share will be worth under this ratio? The way we calculated ratios in grade 7, same thing here. How much will one Swiftcom share be worth? Remember, cross multiply 2 times x, 2x. 1 times 6, that is 6. To get the value of x, divide both sides by 2. X equals 3 kwacha, which means one Swiftcom share is going to be worth 3 kwacha. Okay, this is the offer price per Swiftcom share. 3 kwacha per share. Any questions? Wonderful. So now part 2. From the perspective of a Swiftcom shareholder, is this a fair offer? Compare the offer price to the valuations you calculated in part A and Swiftcom's current market price to justify your answer. Okay. So now we're looking at it from the perspective of a Swiftcom shareholder. You say, is this offer price fair to you? So first thing we need to see, we need to compare is with the current market price of the Swiftcom share. Okay. Swiftcom shares are selling for 4 kwacha per share. And Zamtel is offering you 3 kwacha per share. Is that fair, colleagues? I don't think that one is fair, right? The offer price to a Swiftcom shareholder is 3 kwacha. But currently, Swiftcom's shares are going for 4 kwacha. So this is the first justification that this is not fair. That offer price is not a fair offer price because the Swiftcom shares are currently selling for 4 kwacha on the stock market. So why should you accept a 3 kwacha? Then next we need to compare this 3 kwacha, this offer price with the valuations that we calculated earlier. Remember when we were getting the value of Swiftcom using the valuation techniques? Okay, when we used the PE ratio method to value Swiftcom, we said the value of Swiftcom was 500 million. We can find the value per share under the PE ratio method. Okay, the value per share under the PE ratio method. You're just going to divide the value of Swiftcom divided by the number of shares. Okay, that's what we're doing here. Just to get the value per share, it's just the value that we calculated by divided by the number of shares. Okay, so under the PE ratio method, the value per share of Swiftcom is 5 kwacha, and they want to offer you a 3 kwacha. Is that fair, colleagues? If you're a Swiftcom shareholder, you have seen these calculations for yourself. You have done these calculations, you have seen all under the PE ratio method, the value of Swiftcom is 500 million. There are 100 million shares, so each share is worth 5 kwacha. And Zamte was trying to offer me a 3 kwacha. That's not fair. Under the book value method, say the book value of Swift.com is 300 million. So under this method, the value per share, just divide this 300 million by the 100 million shares, the value is 3 kwacha. So under the book value method, that offer price of 3 kwacha per share is the same. Okay, so under this book value method, it's fair to a Swiftcom shareholder, the offer price. Okay. Then under the dividend yield basis, the value per share of Swiftcom was 1.3 kwacha, and then somebody was offering you a 3 kwacha. So under this method, it's the offer price which somebody was offering you is okay. Okay. The offer price somebody was offering you is okay. Okay. Yes. So all in all, I would say that offer price which Zamtel is offering the Swiftcom shareholders, I would say it's, since with this method it's a 50-50. Okay, it's 50-50 because two methods justify that 3 kwacha offer price. But the market price of the Swiftcom shares and the PE ratio method make that offer price unfair to you. So I would say it's a 50-50. So it's just these are the type of questions where you give your opinion. Okay. Yeah. So any questions? Okay, so let me just put the final answer like this. Offer price, 3 kwacha, market price, 4 kwacha, unfair. Yeah, the shareholder. Offer price, 3 quarter. And under the PE ratio method, value per share was 5 kwacha per share. So that would be unfair again to Swift shareholder. And under the book value method, the value per share was 3 kwacha. Okay, so if you use the book value method, it's fair for the Swiftcom shareholder. Okay, because the offer price and the value per share according to the book value method are the same. Okay. Then under the what's this dividend yield, 1.33. So here again, if you use the dividend yield basis method, that offer price, if you're a Swiftcom shareholder, is fair enough. Okay. So it's up to you to give your opinion to which basis you give your final conclusion to. Okay. If you want to choose the market price as the deciding factor, you just okay under the because the market price is higher, so an offer price of 3 kwacha per share is unfair to a Swiftcom shareholder. So you give your conclusion.